Good evening and welcome to today's lecture. We stopped last week with the description and the discussion of the US banking system, and I hope I've given you a short summary of what the US banking system is all about. It's quite different from most other banking systems, both when it comes to the number of banks, when it comes to the structure of the banking sector, geographically, also related to total assets and to business models, but also when it comes to regulation. Because it's one of the largest banking sectors it is the largest banking sector in the world, not one of them, but it is the largest. Regulation is quite diverse and done by several government agencies. And now I would like to spend a few minutes on talking about supranational banks. Because so far we have only talked about banks at the national level, also government-owned banks, private banks, regulatory agencies, and now we talk about supranational banks, because on a national level, usually you have various credit institutions who give out loans, and they also interact, of course, with the central bank, but in contrast to government-owned banks who pretty much do the same and have the same business models as private banks have, supranational banks are very much different from private and government-owned banks. They are also government-owned banks, but they have a completely different business model and a completely different purpose. First of all, they are usually supported and supervised by several countries, not just one single country. And they fulfill special promotional tasks. Do you know any examples in addition to the banks I've listed here? Well, no. These are more or less the supranational banks we have. Note that I'm not talking about banks, private banks, who engage in business in different countries, but these are government-owned banks. And we'll see that in most of these cases, these supranational banks are actually part of the United Nations system. And what examples are there for supranational banks? First of all, the World Bank Group. Then second, the International Monetary Fund. In a strict definition, this is not actually a bank. Then we have the BIS, the Bank for International Settlements, and also the European Investment Bank. These are the prime examples for supranational banks. And the first two are part of the United Nations. Let's start with the World Bank. Usually we talk about the World Bank, but in fact it's the World Bank Group, because the World Bank Group consists of 5 banks. So the International Bank for Reconstruction and Development, the International Development Association, the International Finance Corporation, the Multilateral Investment Guarantee Agency, and the International Center for Settlement of Investment. Now, legally and strictly speaking, these are 5 distinct banks that form the World Bank Group. But in fact, usually we refer to all of them as simply the World Bank, because they are in the same house. They are, it's one organization. And legally, these are 5 entities. And they are, of course, well integrated. Its goal is the development and giving out development aid to less developed member states of the United Nations. So for the World Bank, development aid and helping developing countries is the main purpose. Now, why is this important? Because we will see that the IMF, the International Monetary Fund, has a completely different duty and a completely different purpose, but the World Bank and the IMF are usually interchanged and intermixed in the news. The World Bank is often criticized for having the right purpose, helping developing countries, but using the wrong instruments. For example, they do not provide transfer payments, but they only give out loans and they use credit to help developing countries. So what does it mean? these countries have to pay back the loans they got from the World Bank. And of course, they will also try to, well, as any good lender would do, they are trying to keep a close look on their loans, and they will only give out loans if the countries, the developing countries who are applying for these helps, are using the loans in a sensible way. And if they're not, well, the World Bank will withdraw funds. And do you know why also the World Bank is often criticized, especially in left-wing media? Yes?
I think about many environmental scandals financed by the World Bank.
Yeah, well, that might be that there have been some scandals. There have been numerous scandals. For example, the former president and chief of the World Bank Group, Paul Wolfowitz. Does anyone remember Paul Wolfowitz? He used to be, I think, the deputy secretary of defense during the George W. Bush administration. He used to be one of the falcons in the Bush administration, and he was probably one of the most conservative members of the Bush administration, and he was chief executive of the World Bank, and I think he had to resign because he made sure that his wife also got a nice cushy job at the World Bank. So there was some corruption there, and then he was fired. So there have been a lot of scandals. No, another reason why the World Bank is often criticized in the media. The World Bank is, it used to be dominated by the United States. For example, Paul Wolfowitz, he's an American, and traditionally the president of the World Bank Group came from the United States. And there was an agreement between Europe and the United States that the World Bank is usually headed by someone from the US, whereas the International Monetary Fund is headed by someone from Europe. This is why, for example, right now we have Christine Lagarde as the president of the IMF, because she's from Europe. And over the past couple of years, of course, the BRICS states, Brazil, especially China and Russia, have criticized this system where Europe and the United States just give the other side these jobs at high places at the IMF and the World Bank. And because the World Bank is in charge of the United Nations system of giving out loans for as economic development aid, and because the World Bank is dominated by the US, of course, other countries have criticized their business style, that it was just simply an instrument for the US to support their overall foreign policy agenda. Yeah? So we have our military, we have our State Department, and we also have the World Bank, which we can use to force other governments into one direction or another. So this has been a frequent criticism of the World Bank. What members and what 5 constituents do we have in the World Bank Group? We have the IBRD. Members hold shares of capital in relation to their economic strength. It can raise capital itself, and it will grant development aid loans. The IDA has the same objective as the IBRD, but loans are granted interest-free or at a high discount. It cannot raise capital on its own, but it can only finance it through contributions from member states and the profits of the IBRD. Now, member states, those are the member states of the United Nations. The IFC promotes private sector development in developing and emerging countries, financing through member contributions, and it can also borrow from the IBRD, and it finances itself by issuing bonds and retaining earnings. So they more or less have the same goals, but there are slight differences when it comes to the way these banks are financed. The MIGA gives out guarantees with the aim to promote foreign direct investments. So they do not give out loans, they only give out financial guarantees. And the last member, the last constituent bank of the World Bank Group, promotes dispute resolution between states and investors within the framework of bilateral and multilateral investment protection agreements. So they do not give out loans at all or guarantees. They simply try to facilitate direct investments from one country in another. So this is the World Bank. Now you probably know the IMF, the International Monetary Fund, or the IWF in German, the Internationaler Währungsfonds. It's also a specialized organization of the United Nations and legally not a bank, but it's usually also considered to be a near bank. The tasks of the IMF are the promotion of international cooperation in monetary policy, the extension of world trade, the stabilization of exchange rates, and some other goals. And for this purpose, the IMF can act as a lender of last resort to a member state. So please remember that the World Bank Group gives out loans and tries to help emerging and developing countries, whereas the IMF is only concerned about financial stability, stable exchange rates, the promotion of world trade and free world trade, and cooperation when it comes to monetary policy. So it's closer to a central bank than being a development aid agency. It can also act as a lender of last resort to a member state, and you might know for which states the IMF has done this before. Any examples? It is quite heavily engaged. It used to be engaged, for example, in Argentina during the 90s. And right now it's part of the group that tries to solve the problems of Greece. Voting rights, special drawing rights, that is the use of loans. So the ability to get a loan from the IMF and the payment obligations are determined by a key and in particular an amount that reflects the economic strength of each member state. And this has also been criticized because this distribution mechanism was fixed for quite a long time, and of course during the time when this distribution mechanism was fixed and was agreed upon, there was a time when Europe and the United States were much more powerful, economically speaking, than, for example, China. And right now, it works like this, that, for example, I think the United States have a very large stake in the IMF, probably 10, 20, 30%. They pay a lot of money into the fund, but this also enables them to get a large loan in case they had some problems. So these are called special drawing rights, Ziehungsrechte im Deutschen. And in case a country is in dire need of a bailout, it can ask the IMF to step in. It can ask the IMF for a bailout loan, but the IMF will only do so if the country agrees on structural reforms, for example, to its pension system, to its healthcare system, to its political system, etc. And this has always been criticized quite heavily, and especially during the Euro crisis, because this is something that is quite problematic, especially on a political level. Why? You have a supranational organization like the IMF that is not democratically elected. These are not politicians. These are people working or have worked for other central banks, who have made their careers in central banks, and also some politicians. And suddenly, because a country like Greece needs a bailout, the IMF is now granted, implicitly granted political power without any election. And they can try to force Greece to change its political system, its pension system, healthcare system, and this is quite problematic. These are the structural adjustment programs. Okay. This was a second example of a supranational bank. The third example is the Bank for International Settlements. Do you know where the BIS is located? Where the headquarters is? Or the headquarters are of the BIS? No idea? Usually people do not know the BIS, but they know a special committee of the BIS. And the most famous committee is the Basel Committee on Financial Regulation and Supervision. This Basel Committee, the BIS, the Bank for International Settlements, is located in Basel, on the German and Swiss border. It's a supranational bank. It has been formed, and the members are central banks and regulatory agencies. And do you know why the BIS was founded? And also why it got this name? What payments needed to be settled? One. After World War I, exactly, after World War I, the First World War, Germany had to pay a lot of reparations to France and Great Britain. And the BIS was installed in Switzerland to settle the payments Germany had to make to France and Great Britain after the First World War. And its duties have, of course, changed over time. And nowadays, they form a forum for central bankers to discuss financial stability issues and questions of financial supervision and regulation. And this is nowadays its goal, the promotion of cooperation of central banks in economic and market issues. Also, it's the headquarters of the Financial Stability Board, the FSB, which was founded after the financial crisis, the Basel Committee on Banking Supervision, and also the IAIS. Does anyone know what IAIS stands for? It's the International Association of Insurance Supervisors. So it's exactly the same as the Basel Committee, more or less, for banks, but for insurers, the International Association of Insurance Supervisors. The voting rights depend on the ownership interest, and it is prohibited from accepting bills of exchange and lending to governments. So it's not really a bank nowadays, but more or less a lobby group for central bankers. Okay. And last but not least, we have the European Investment Bank. The European Investment Bank has the task of contributing with their own capital resources to a balanced and smooth development of the internal market and the joint market in the interest of the Union, of the European Union, of course. And as a special financial institution, it is located alongside the remaining other European Union institutions. So it is not bound by instructions from the Commission. It's its own constitutional character. Capital owners are the member states of the EU, and additional financing is also provided by the ability to issue bonds, and the main focus of its work is on the improvement of intra-European economic social cohesion, development of trans-European networks, and environmental protection. If you drive through Europe, you might see some development projects for streets and highways where you can see that, for example, important highways, also some water canals and some telecommunications projects. They are co-financed by the European Investment Bank because these are important projects to help European states to come together. So, for example, this becomes quite clear for the major highways, for example, between France, the Netherlands, Belgium, and Germany. Those highways, if there are new highways to be built, or if these highways are improved, these are co-financed by the European Investment Bank. Okay, but as you can see, these supranational banks have quite different purposes and business models as, for example, private banks. And in some cases, they are not even banks. The BIS and the IMF are, strictly speaking, not banks. Okay, do you have any questions concerning these supranational banks? Okay, then let's go to the next part, which is banks' business models, and we'll start with commercial banking. Now, we've talked a lot about central banks and why banks exist, and we haven't talked about what banks really do in detail. We know they give out loans, we know they accept deposits, and because of their accepting deposits and because of their credit management and credit risk acceptance, they are special and they are different from in normal industrial sectors. But we haven't talked about the specific business models some banks have, and usually you can distinguish between commercial banking and investment banking. Commercial banking being accepting deposits and giving out loans. And we'll start with the deposit side and deposit business. Now, why do banks accept deposits? Simply why? Because people save money. People want to save money, and they put money in their bank account, and they will have a bank balance, they will have deposits, they will use a credit card, and these are all part of the liability side of the bank. Why do we save? Well, savings and saving is one way to smooth your intertemporal consumption as a household. Perhaps you have some money now and you want to spend some of this money tomorrow. So what do? You save the money. You put it in your bank account, and every country, every sector, every economy has a different savings rate, which is this percentage of the available household income that is not spent on consumption. And actually there is a large variation over time and across different countries. For example, there are countries where you do not save money with a bank at all. There are some countries where all the households bring all their money to banks. And this, of course, also changes over time, depending on the average household's risk aversion. I've brought you, which is on the next slide here, you can see the private consumption in blue and the private savings in red in Germany in billion euros over time. And you can see that there has been a steady upward trend, both in consumption, of course, and in savings. Why? Simple reason. Because we've had a positive GDP growth rate. We've had economic growth, and you can see the growth rate here. So households were able to spend more on consumption and also to save more. But you can also see that, for example, during some years, savings are actually quite low. Take, for example, here this year compared to this one. You can see this, there is much more money saved by households in 2008. You can also see that here, actually there was no growth at all. Actually, we're in a recession. Economy rebounds, especially here from 2010 to 2011. And you can see there is some movement here in consumption and in savings. So what is saving? Theoretically, of course, it's a limitation of present consumption to increase future consumption. Why do people care at all? Because they need to fulfill and they need to secure the necessities of daily life, also in the future. And we have a tendency to save too little. Usually households and humans have a tendency to prefer present consumption to future consumption, which is quite natural. So because of this tendency, of course, people save too little. And you can always see this when it comes to pension plans and retirement plans, because people have saved too little money so that they need assistance during high age and when they become old. Why is saving sensible from an economic point of view? Saving creates capital, and capital can be used by households to invest in companies, and companies and firms will use capital to invest and therefore boost production. So capital and saving is, to a certain limit, is quite beneficial to the economy, and it's also an important instrument to prevent social problems and social dissent in high age, and also welfare loss. So it's sensible for the household, but it's also sensible on a macroeconomic level. Okay. Why do you think do these savings rate fluctuate over time? Yeah?
Inflation, for example.
Inflation. Yes, not directly inflation, but
If you see there's inflation, inflation rates are rising, and there might be a hyperinflation coming up.
yeah.
You spend all your money.
What is closely connected to inflation?
Inflation?
No,
Deflation.
interest rates. Households will not directly care about inflation, but they will immediately see the interest rates that are being offered by banks on their accounts. So, for example, if you see an interest rate that is paid on the money in your checkings account of 4%, you're more likely to save money than, for example, during the current times of zero interest rate policies. Yeah. So interest rates fluctuate, and as a result, also savings rate will fluctuate. What else? Inflation, interest rates,
Maybe uncertainty. So,
economic uncertainty, yes,
so if I'm uncertain about the future, maybe I
Yeah.
should now save more.
Definitely.
Actually,
economic outlook. What else?
In connection with economic outlooks, political outlooks? Maybe?
Yes. Perhaps not so much the economic outlook, but the current economic situation. For example, if you look at the statistics, you can see that here, from 2008 to 2009, so right in the middle of the financial crisis, we had a small recession, and as you can see, consumption almost stayed the same, but savings were reduced. Of course, if you have high unemployment, if you have no economic growth, people in households will lose their jobs, and they are no longer able to save, or they have to use their savings to survive. So in many cases, because the savings rates will also reflect the current stance of the economy. So unemployment, inflation, interest rates, economic and political outlook. These are the reasons why you can observe timely changes. These are very strange changes over time. Thought I'd looked through all the slides. So these are the reasons why you have time variation in savings rates in one country. You also have variation across countries, and you can see this in this table. Here you can see the saving rates of private households in percentage of the available income for France, Switzerland, Germany, Great Britain, Canada, and the US. And you can see, first of all, these are the years of the financial crisis. You can see that the savings rates decreased in France, increased in Switzerland, decreased slightly in Germany, decreased in Great Britain, and increased in Canada and the US. Do you have any idea why these savings rates differ across countries? Yeah.
I guess on one hand the mentality of the people and
Cultural differences? Yeah.
and on the other for sure the current economic situation. So
Yes.
yes, might be
the current state of the national economy. So the unemployment rate, for example, in Switzerland was different than in the US. Yes.
Available income is different in these countries.
Yeah.
So the Switzerland will be
Differences in the average income, of an household. Cultural differences in mentality, and what especially is different. Yeah.
Monetary policy of the central banks and therefore the interest rates.
Yeah, monetary policy of the central bank, yes, also.
Maybe tax rates.
Tax rates could be different, yes. And a whole lot of other things. For example, the US, in the US, historically speaking, you have seen a lot of more bank failures than, for example, in Switzerland or in Germany. So I would say it's not just a cultural difference when it comes to language and heritage, but it's also the question whether you or your family have ever experienced, for example, a bank run. There are some, it's quite interesting, there are some research papers that have looked at the question whether bank customers behave differently in the US if they have only recently migrated to the US. And there's one paper in particular that has looked at customers who came to the US from a country in which they had just experienced a banking crisis. And if you have on your own experienced a banking crisis, and you might also have lost all your savings in a bank failure, you are much more skeptical of banks than, for example, customers are here in Germany or especially in Switzerland. So it's a question of mentality, of experiences. Yes?
maybe there's also a difference in interest rates.
Yes, of course. Differences in interest rate, but also, and I think this you can quite clearly see in Great Britain, Canada, and the US, totally different mentality when it comes to investing money. The United States and also Canada and the UK, but especially the US, have a long history of people investing in stocks and investing in shares of companies, whereas stocks are quite are usually seen as very risky investments in Germany. And I think this is also a question of investment mentality, that people in the US are much more prone and much more likely to invest in stocks than to leave the money with the bank. And these reasons might explain why there are differences in savings rates across countries. Okay. Now let's go to the different types of bank deposits. We have demand deposits, fixed term deposits, and savings deposits. Demand deposits are available overnight on the current account. Fixed term deposits can be further distinguished between into fixed duration deposits and notice and deposits at notice. So time deposits and deposits at notice. And savings deposits, this is money with an unlimited duration and a notice period of at least 3 months, and you are issued a certificate. In Germany, this is what we know as a Sparbuch. This is a savings book. You are issued a certificate. This used to be a small book. Nowadays, it's an electronic card. And the money is on the account with an unlimited duration, but you have a notice period of at least 3 months if you want to withdraw your money. So these are savings deposits. Now, why do banks offer these different types of deposits? Yeah?
One day we have a bank run at the beginning.
Yeah?
everyone will be able to take all the money out of the bank. So we have like steps and like current money, 3 months, long term.
Yeah. Yes. It makes it easier for the bank to plan its liquidity and to assess its liquidity risk. If it only offered short-term, readily available deposits, all the deposits could be withdrawn immediately by the customers, and this would increase the bank out probability. By offering different types of deposits with different notice periods, it can decrease this liquidity risk. But also, customers want this, or at least during normal times when we have positive interest rates, bank customers will require banks to offer different types of deposits because they do not want to leave all their money for 5 years with the bank, but they want to invest a certain portion of their money in a very short-term deposit, one in mid-term, perhaps one long-term deposit account. And this is why banks offer these different types of deposits. They have to meet the customer's requirement in a free competitive market, because if one bank does not offer this, you will immediately see another bank offering this type of deposit. And in fact, I have one slide here. It's quite here. We have it. This is quite interesting, and I wasn't really able to sufficiently and to translate this well into English, because these are actually quite German terms. If you go to a regular German savings and loan association, to a German Sparkasse, at least they used to offer quite a bunch of different deposit accounts. And the reason for this was that they were quite, during normal times of positive interest rates, they were in need and they wanted to attract customer deposits. And the way they did this was to do a little marketing. And they created different special savings programs and special savings and deposit accounts. And for example, they called it Wachstumssparen, which just meant that the interest rate increased over time. So you had some growth in your savings and your interest rate. You had premium savings or Prämiensparen, which just meant that if you left a certain amount of money in your account for some time, you got an extra 0.2% interest rate. So you got a premium. You also had Zielsparen, target saving, Extrasparen, Bonussparen. Those were just regular deposit accounts with some marketing gag attached to it to attract new customers. Of course, in a time where interest rates are at 0%, these forms of marketing no longer make any sense, but it used to be quite common during the time of the mid-2000s to the start of the financial crisis. I also remember one type, the DAX-Sparbuch, the DAX savings account, which just meant that you got, say, 1% interest rate plus an extra interest rate, an extra percent, for example, if the DAX, the German stock index, performed quite well. So you got 1% plus X, and the X percent depended on the performance of the DAX stock exchange index. And well, this, as I said, this was common in 2006, 2007. Okay. Another reason why banks want your deposits. They need deposits for financing, but let's be honest, in the European Union, in the Euro system, and also in the US with the zero interest rates, well, financing is not really the problem. You can always get money from the central bank. But why are banks also interested in attracting customer deposits? Actually, a very simple reason, but a reason that is becoming more and more important these days. Why do you want customer deposits? It's not very, it doesn't cost you much, but central bank is also as cheap. It doesn't really help you because, let's be honest, it's more risky than perhaps some other forms of financing. But what is one major reason why banks want to attract customer deposits? Yeah?
Because then they get the customers.
Yes,
to
they
their
want
bank.
to attract customers. Because if you are able to attract a customer to bring his or her deposits to your bank, you have the customer's contact details. You can try to form a customer relationship with this person, and you can try to earn provision fees. You can try to give out a loan at a later date. So this is why all the banks try to attract customers, and this is also why online banks, ING DiBa, ING DiBa, and other online banks that are active in Germany, they have quite aggressively tried to attract customer deposits because back then it was cheaper for them. They wanted to attract the deposits, and also they wanted, because they're dealing in mass, they wanted to attract large numbers of customers. And this is one major reason why banks also offer different types of deposit and savings accounts. Now, this should be quite clear to you. For the bank, deposits are a way of external financing. They can, of course, also use bank's equity, and depositors will usually not invest in the equity, with one exception. In cooperative banks, of course, customers are also shareholders. You also have hybrid securities, which show features of both external and internal financing. And external financing of a regular bank is usually solely based on deposits. If you go back to the first set of slides, in the very first week, I have shown you the asset and liability, that the balance sheet of, I think, the Hamburger Sparkasse, the Savings and Loan Association of Hamburg. And this bank, I think, had almost 70 or 80% of its liability side composed of deposits. So it finances itself almost exclusively by the use of deposits. This is different for Deutsche Bank and Commerzbank, of course, but for the savings and loan associations and also for the cooperative banks, they depend heavily on deposits. Demand deposits, as one example of deposits. These are overnight deposits of non-banks or other banks. It's a credit balance in the Giro business account, and the purpose, of course, is handling cashless payment transactions. Can also be used as a disposition mass, that is, as a buffer to cover unexpected payments in the short term. You usually get no or very low interest rates, and this is the price you have to pay for permanent availability. This is Deutsche Girokonto. Usually interest rates vary, but rate adjustments are quite rare, especially when overall interest rates are zero or negative even. Then next are fixed term deposits. These are deposits with a fixed term. These are called time deposits, or with an agreement on a certain period of notice. Those are deposit at notice. And usually a condition to enter such a contract with the bank is that you want to invest at least, say, 5,000 euros or 2,000 euros. And for private customers, this is an alternative to savings deposits. And for corporate clients and banks, it's an investment instrument with very low and very small interest rates on a temporary basis if you have a liquidity surplus. the German students will immediately know this. This is the ominous and infamous Festgeldkonto, for example, of Bayern Munich. You know the German football or soccer team, Bayern Munich, and the now infamous and also right out of jail manager of Bayern Munich for years bragged about the fixed term deposits of Bayern Munich, that they had so much money, they were swimming in money, that they could buy players just from their fixed term deposit account. That's Festgeldkonto. So this is something that might be of interest to corporate clients as well. Of course, again, only during times of positive interest rates, in which you, for example, would get 1 or 2%. I think a couple of weeks ago, I found a small slip from my grandmother, who had invested, I think, 10,000 euros in such a fixed, in a time deposit account, and it paid out 6.5% interest rate. Now this risk-free. Quite an investment, yeah. But that was in the 90s. Interest rates depend, of course, on the current market interest rate level, the duration, the time the period of time you want to fix your investment, and the amount you want to invest. Okay. Here on these in these tables, you can see the effective interest rates per year in percent. And the volume invested by private households, and these are statistics from Deutsche Bundesbank, and you can see that the overall interest level, the average interest level, has decreased from 0.79% to 0.65% in just half a year to 2015, and you can see this was up to 2 years, and this was over 2 years. So if you were a long-term investor in these deposits, you got 1% extra. But of course, both of these statistics look quite different right now. Okay. So how can the falling interest rates and the declining investment volume be explained? Well, market level interest rates. Zero interest rate policy. You will get no money on your deposits with a bank, and why should you invest in a fixed term deposit if you get 0%? No household will do this. Okay. Now, next to fixed term deposits, you can also trade in money market papers. These are tradable on an exchange, and they are called certificates of deposits, or also money market papers. These are marketable receipts for deposits. And in this way, fixed-term deposits become tradable. For example, you take a fixed-term deposit, and if you have deposited your money, say, with Sparkasse Leipzig, you can only withdraw it from at Sparkasse Leipzig, and you can take the cash and bring it to some other bank. But if you want to trade it, you cannot simply trade your certificate. And especially in the United States, deposits can be traded, and these are CDs, certificates of deposits on money market papers. And if you ever see a bank in the US, you might see an ad, a poster in the bank's window in which they advertise the CD rate. And this is the most important interest rate on their deposits, and because these certificates of deposits are tradable, they need to be standardized. And this is why they usually advertise with the CD rates, and these are the risk-free rates they pay on risk-free deposits. As I've said, to make it marketable, it needs to be standardized. They have standardized duration and standardized volume, and you have fixed return or variable rate CDs, and these are called floating rate CDs. For these certificates of deposits, the interest rates can vary over time. The duration is usually up to 1 year, and these most important examples are CDs, commercial papers, commercial industry firms can of course also accept deposits. this is unthinkable, I think, in Germany, but in the US it's quite common. They can also accept deposit like cash, and they can also give out these commercial papers in which, well, they are actually quite close to corporate bonds. And T-bills, these are treasury bills issued by the US Treasury. Main center of trades are London and New York. Okay, these are certificates of deposits, CDs, and we also have savings deposits. This is a classical money investment for private customers. You can see that savings books, the Sparbücher in German, are more and more replaced by savings cards, which look like a credit card, but its use is rather limited in contrast to a credit card. You can also withdraw money from the ATM, and until 1993, the word Spareinlage, the German word for savings deposit, Spareinlage, was legally protected, and you could not simply offer a Spareinlage. Okay. Now, you've seen before that I quite unsuccessfully tried to change this in the original file to a paragraph. In Germany, we have legal order, executive order, or ordinance that regulates the accounting of banks. We will later in the lecture see that banks need to apply special accounting rules, and these rules, at least in Germany, they are included in the Verordnung über die Rechnungslegung der Kreditinstitute. Kreditinstitute is quite clear, credit institutions. Rechnungslegung is to lay a calculation. It's a German way of saying accounting. And Verordnung is legal order or executive order. And savings deposits are regulated by this executive order on the accounting of banks, and they are defined as open-ended funds that fulfill the following conditions. They are marked as a savings deposit by drawing up a certificate, a savings book. So you need a special certificate. And if you go into a German bank, this is quite interesting. You will see that in case, for example, someone has lost his card, you cannot simply say, okay, we will just give you a new card, because savings accounts and savings deposits are a very special financial instrument under German law, and they need to be drawn up by a special certificate. The banks cannot simply close an account. If you have, for example, lost your savings book, or they have a savings book and savings account, a savings deposit account, for which no owner can be identified, they need to make an official, they need to draw an official letter, and they need to make an official public announcement that they are asking the owner of this deposit account to come forward and to claim the money. And if, with a certain period of, until next month, if no one comes and says, okay, this is my savings account, they can close the account. And if someone has lost the savings book, also, this is the same way it's done. And if you go into the headquarters of a German bank, for example, Sparkasse Leipzig, in a very small corner of the bank, there will be an area where they have all these public announcements concerning the savings deposits. They're not intended for payment transactions. You cannot pay in the supermarket with them. They have a notice period of at least 3 months, and they are not intended, and this is important, you cannot open a savings deposit if you are a corporation, if you are a limited company, if you are a cooperative, if you are an economic association or a partnership, which in German is a Personengesellschaft, KG, and Einzelhandelskaufmann, etc. And also some companies located abroad having a comparable legal form. So savings deposits are only intended for private households. There are some exceptions for charitable, benevolent, especially charitable and ecclesiastical purposes. So if you are a German church, you can also open a savings deposits account. Okay. Now, I've already talked about these special savings programs. These were marketing instruments by the Sparkassen, by the Savings and Loan Associations a couple of time ago, but I think they have lost some of their purpose due to the zero interest policy. Now, we also have checkings accounts, and we use our checkings accounts to pay our debt and to pay our bills. And we have several possibilities to pay our bills by cash, by book money, and other monetary surrogates or money substitutes. And payment transactions usually take place directly between the involved parties, through payment transaction companies, or through banks. And in many cases, banks bear the risk of not being able to fulfill all payment wishes of the customers. And also the use of electronic cards has changed the way people pay their bills and how they transfer money. Now, what are the usual ways of transferring cash and transferring money? First, by cash, banknotes and coins, which is legal tender. They have to be accepted by every shop and every person in Germany. We have book money. These are demand deposits and credit balance at banks available at any time. Checkings accounts. You also have electronic money. These are prepaid payment units on a chip card, and this is different to the Euro check or the electronic bank card we use quite frequently in Germany. For example, does everyone know how this works? I don't have my card with me, especially for the Erasmus students. How do you pay in a supermarket in your country? Do you pay with a credit card or do you pay with your bank card? Do you pay with cash? Credit card, okay. Quite common in the US as well. In the United States, most people pay with credit card, even very small amounts of money. What do you use in your countries? Credit card as well? In Germany, we don't use credit cards. Most shops actually will try to avoid credit card because the shops have to pay a fee in case a customer uses a credit card. So what they will do is they will try to get the customer to pay in cash or to pay with their bank card, with their checkings account. And the difference, we call this EC-Karte. It used to be an abbreviation for Euro-Check card. We pay with our Girokarte or EC-Karte. And the difference is that actually you pay with this card, but you only transfer your bank details to this shop or to the supermarket, and you allow the shop to withdraw money from the bank using the bank detail and the account details you have just transferred to the supermarket. And usually the shops will have to pay a small or no fee for this service.
But this is dramatically changing at the moment. I mean, even
Yes.
Aldi now accepts Visa and MasterCard.
Yes, it's changing.
They lowered their fees this
Yeah.
year.
It's changing also because of a different development. Because nowadays you have, I will talk about this later in a moment, but it's interesting to see the differences from country to country. US, credit card and cash. Japan, does anyone know how this works in Japan? Or at least it used to. No credit card at all. This was one common myth and one urban legend that in a highly industrialized country like Japan, you could pay with a credit card everywhere. Japanese people are fixated on cash. They carry around thousands of euros in cash with them. First of all, because public safety is high and there's no chance of you getting robbed in the streets. And second, they were not accustomed to credit cards. And you usually have to pay in cash, and you will never pay with a credit card in the supermarket. Totally different to the US, for example. And as I've said, in Germany, we tend to use our bank card. And this is changing. Why? Because there are several new players in the market now. You might have heard of the term fintechs. These are small startup companies who try to use the benefits of digitalization and online banking to attack banks. Because the traditional business model of a bank is a couple of thousand years old. Accept deposits, give out loan, and enable people to pay their bills. And fintechs have one advantage. They want to gauge the possibilities and the technological possibilities due to digitalization to get what? What is the basic business model behind almost every fintech?
Customer information?
Customer details, customer information. They want to know who you are, what you do with your money, what your consumption preferences are, and they want to exploit this data, they want to exploit these details on your transactions to make money. And how do you do this? You do not give out loans. If you start to give out loans as a fintech, as a startup, you do not have the capital. You do not have the financing to do this. Do you want to accept deposits? No, because then you just become a bank. What you do is you start a startup. You start with 10 people. You pull up a nice app, and you try to facilitate one part of the transaction process of a bank. On which the bank has lost interest or the bank has simply not focused on, because the banks were usually focused on lending and deposit taking, and transactions and payment transactions were simply not a big earner for banks. Now fintechs are trying to attack this weak point, this how do you call it, this pressure point and weak point of banks. And this is why it's changing. Suddenly now, you do not only have credit cards, you have banks, you have credit cards, you have Amazon, you have Apple Pay, you have conglomerates and groups of banks that try to do the same PayPal has done 10, 15 years ago. You have PayPal, you have the German Savings and Loan Associations and the cooperative banks. They have done the same thing. I think it's called PayDirect. PayPal, different name, same thing. And people are trying to use more payment services. And this is why this market is evolving quite quickly. I was fascinated by, by a small example, a personal experience. A couple of weeks ago, I needed to make a money transfer to a colleague in the United States. And I found it quite interesting that I needed to transfer 2,000 euros. And the colleague told me that he doesn't have a bank account, but he has a PayPal account. So I needed to transfer the 2,000 euros to his PayPal account. And he just sent me a link. I received the link via email. I logged into PayPal and I transferred the 2,000 euros from my bank account via PayPal to his PayPal account. So this is how this is done nowadays, I guess. What are the differences when it comes to the different payment methods? Cash-based payment implies an obligatory acceptance of the payee. You have to accept legal tender. Cash, of course, is exposed to loss risk due to theft, storage and security costs, and zero interests. Now, storage and security costs is, I guess, quite uncommon. One famous example I recently saw on Narcos, that it seems that some drug lords lost millions and billions of dollars because it was just rotten. They buried the money and they didn't think about the storage and security costs. Yeah. So this could happen. Money can burn down with your house. It can be lost. It can be stolen. You don't get any interest on cash. Book money, in contrast, is a claim against a credit institution with a claim to cash at any time. You also have a risk of a bank run, and the bank must immediately comply with a claim for payment. But usually you have deposit insurance, so your cash, at least in your bank account, and your book money is safe if your bank is in a deposit insurance scheme. Payment transactions, all payment processes that are all transfers of all means of payment. And what do you expect as an involved party? You expect your payment transaction to be quick, to be fast, to be secure and inexpensive, to be cheap. And this is where all the think tanks start to pop up. They, of course, want to make it simple. They want to make it inexpensive, cheap, and cheaper than a bank account, and they want to make it simpler than the online banking tool of a regular German bank. You also have direct transactions. Sometimes you have a processing company involved, and sometimes you have a bank involved. Okay. Direct transactions are, of course, the simplest way to transfer money. I will simply pull out a 100 euro bill and I give it to you. And this is quite common in a supermarket, for example. And it's also the preferred option when sums of money are related to criminal offenses. That is, when it comes to tax evasion, drug trafficking, black market activities, and when you do not want any documentation on the payment transactions. This is what is also referred to as money laundering, Geldwäsche. It's the attempt to channel money from illegal transactions into official payments. Why? As a child, I did not understand the concept behind money laundering. Why would you earn money and you spend it, but why do you want to launder your money if you are in an illegal business?
For example, if you have $1 billion in cash and it's illegal money, and you launder it by, for example, investing it in a legal business like a restaurant, you can use it after for everything.
Why can you use it afterwards?
Because it's in the legal system.
Yeah, but you could also use it before, right? If you earn cash, and usually in an illegal activity you will earn cash, you can also use it before.
Yeah, but I mean, if you invest, then you want to make more money out of it, and you put it on your banking account or so.
Yeah.
Government institutions or some regulatory institutions, they will ask you where this money comes from if it's a huge amount.
If you earn too much money and have no apparent business, it will raise suspicion. And what can you do? Let's assume we are in some form of illegal trade and I earn 1 million euros. Can I buy a house? Maybe yes. No one will ask question, how was he able to afford this house? If I start to buy a Porsche, if I start to buy a company, if I start to buy shares, at some point a red flag will pop up with our tax agency. And the tax agency, the federal tax agencies will think, why is he spending so much money if he has no income, at least no official income? So if you want to use the money at some point you cannot simply pay out cash all the time. You cannot go to real estate agent and say, "Oh, the house, the villa is €500,000. Okay, luckily I've brought 1 million with me." So this doesn't work. At some point you need to make a bank transfer, and then this illegal money is suddenly documented, and it will pop up on the radar of agencies. And this is why, for example, here, for some reason, only just since 1993, we have the German Money Laundering Act, the German Geldwäschegesetz, which regulates that every bank, if it sees a transfer of more than 15,000 euros, it has to report this to, it has to look at this transfer, and if it has is under the impression that this might be from an illegal source, it has to report it to the authorities. And this is an act that aims at preventing money laundering. So actually this is not money laundering. This is just a stupid way for a criminal to put too much money in its bank account. Then of course people will notice this. Most famous example for this, Al Capone was indicted on tax evasion. The officials were not able to indict him on criminal charges related to his business, on his murders, etc. But they just saw that he had no business, but he had extreme. They tried to reconstruct his income. And they made estimations on his income, and then estimated that he must have had an income of such and such $1 million. And they just said, "Okay, you're not paying any taxes, so we are convicting you of tax evasion," and they put him away for life for this. You need to launder the money, but how do you do this?
Restaurants, and then you get extremely high income because you order as you offer so good.
Yeah, a frequent idea is to open some kind of shop which has a high total, not high income actually, high revenues, hohen Umsatz. You have a shop that officially has a high revenue that cannot be so easily controlled by the tax agencies, so usually a restaurant. You cannot control how much food goes in and goes out of a restaurant. And then you have a restaurant that has a high revenue, at least on paper, and suddenly you have laundered the money. And if you ever go to a restaurant where you are under the impression that this is too good to be true, you immediately know that this is a vehicle, an instrument for money laundering. Someone who is in the state tax agency in North Rhine-Westphalia once told me that there are a couple of pizza places in German cities where everyone knows these are run by the mafia. They just know, because it's impossible that these shops have been running for so long with no actual income, with no return, just extremely high revenues. So this is a known secret among tax agencies, that some of these places are just run by criminals to launder money. Yeah.
How can you use internet cafes all over Germany? I think they don't have such a high revenue, but they're still a lot.
Yeah, internet cafes. Yeah, usually internet cafes, restaurants, and nail salons, and also laundromats. Usually places where you cannot control as a government or as a tax agency, where you cannot really control the amount of services and products that are being produced there. So in a restaurant, they will tell you, yeah, we have sold 2,000 meals, but you have no real way to control the accuracy of this information. Yeah.
But if you do the game with the restaurants, and you have the problem that either you also have to have high costs, so you don't have too much profit to buy.
Yeah, there's no problem. You have high costs. Yeah.
So you also buy the companies, you are buying the materials.
This is how it's done.
Okay.
You usually own certain companies that distribute, that are the distributors and the suppliers of these, for example, restaurants. The restaurants are only meant to generate high revenues, no income. So you get a very good deal on your meal, and they will buy the supplies from another company you own. And this is where it becomes organized crime. You need more companies, you need a structure for this to work. And one reason why this has to be so elaborate is because we have the Money Laundering Act since '93. Okay.
Question.
Yeah?
If you check all transactions for money laundering,
Yeah.
and it's from 15,000 upwards, who's doing that? Shouldn't you do it by hand to check if it's legal or illegal in person?
I'm pretty sure that these transactions will be checked manually, because the bank is immediately liable. If, of course, the bank, assume you have a transfer that is illegal or from which the money originated from an illegal source. And the bank is legally obliged to check this. And if they see any indication for illegal wrongdoing, they have to report it. Of course, if they do not do a proper check, they will be liable. And they will be liable to the state. And they will have to pay a fine. So I would assume that each bank will do this manually.
Isn't there an incredibly huge amount of transactions in Germany? Especially with big firms?
Well, for firms, I'm not so sure how this works in detail. They will probably have some electronic mechanisms, but for example, for private households, for private customers, they will definitely do this manually. But this actually was be a nice question to a banker, how they do the money laundering controls. Okay. Now, banks also act as payment facilitators and payment transaction service companies. The first cashless payment transaction in Germany was at the beginning of the 17th century by Hamburg Girobank, and they did payments via account transfers in their own bank. So back in 16 and so on, they did the very first transfer from one bank account to another bank account. And the Giro system in Germany started in 1876 with the establishment of the Reichsbank, which is the predecessor of the Deutsche Bundesbank. And they established a net of supra-regional transfers. In 1909, the postal check was introduced. And today we have the Gironetz der Deutschen Bundesbank, the transfer net of Deutsche Bundesbank. And every German bank must maintain an account with the Deutsche Bundesbank. They must comply with the minimum reserve requirements as stipulated by the Statute of the European System of Central Banks. And large banks and the cooperative banks and the savings and loan associations have their own net for moneyless transfers. And if you want to transfer, for example, money from Sparkasse Leipzig to Sparkasse Dresden, this will be done within the bank's own net for cashless transactions. If customers of payers and recipients do not belong to the same Giro network, payments must be processed via the Bundesbank network. This appears to be and seems to be archaic nowadays, because nowadays we have computers, we have internet, we have big data and so on. But think back 10, 20, 30 years ago, in a time where these transfers were actually done on paper. So you filled out a transfer statement, you handed it to your bank manager, the bank manager inserted all the information into some form of prehistoric computer system. And why did you need a network? Why did you need a gyro network for all these transactions to be executed? Let's assume we have here Deutsche Bank. We have customer A and customer B. And here we have Commerzbank, customer C and D. Now if A wants to transfer money to B, the bank can simply look at two accounts and say, okay, I'll take some money and it will just change from one customer to the other customer, but it will stay on the same balance sheet of Deutsche Bank. Now let's assume A transfers money to C and D transfers money to B. What will happen? 100 euros will go from Deutsche Bank to customer C at Commerzbank, and 60 euros will go, let's say Deutsche Mark, 60 Mark will go from customer D to customer B at Deutsche Bank. The first thing you want to do is what?
Just netting it.
Yeah, just to net your positions. You do not need to transfer 100 from left to right and 60 from right to left. You only need to transfer 40. No? So this is the first thing you will do, netting. And then you have to settle and clear the whole transfer. What is this? You need to transfer the payment details, the account details. This is customer A with account number 4570 and transfer to customer D, name, account number, etc. So you need to transfer the account details, the payment details, and so on. And this is why over time these nets of banks developed for cashless payments. And nowadays, of course, these are quite sophisticated. But you can still see this. Some of the German students, you might have seen this. What happens when you transfer? Who of you has a Sparkasse Konto? An account with a Sparkasse? Okay, only two. What happens when you transfer money? Say, for example, to another account with a Sparkasse, another account with a different Sparkasse, or to a totally different bank. Have you ever noticed?
No.
I actually have two accounts with a Sparkasse, the same Sparkasse. If you do an online banking transfer, within one bank, both accounts will immediately change and show the new account figures. If you transfer it to another bank in the same group, so Sparkasse to Sparkasse, it might take a couple of minutes or maybe a couple of hours. If you transfer it from one bank to a bank in a totally different part of the German banking sector, Deutsche Bank to Commerzbank, Deutsche Bank, for example, to Sparkasse Leipzig, it will take the whole day. It will only be settled overnight. So you can still see some differences there. Yeah?
Hasn't this just been somehow gained by the banks to trick the customers so they withdraw the money from the account and then they have it for half a day or 1 day to invest it and they don't have to pay interest?
This might be some reason, but I think the main reason still is that clearing and the settlement of these transactions is done in different manners.
Is it a technological?
I think so, yes. At least it used to be. I don't think that they do it really on purpose, or that all banks do it on purpose. But I think for many banks, it's the technological reason. Yeah? So this is how the payments are settled. And of course, technology has improved this a lot too. We have ATMs, automatic teller machines, document reading systems, online banking, documentless data medium exchange procedures, and so on. There are some regulations concerning this. For example, EDIFACT, Electronic Data Interchange for Administration, Commerce and Transport. Also the Single Euro Payments Area Procedure, the SEPA, which is quite infamous, of course, because now we have one very large bank number. And this becomes more complex, of course, if you want to transfer money to foreign countries. You can see this. If you come from Germany, you are not really used to this, that it's such a big problem to transfer money. But if you want to transfer money, especially to developing countries, you might be forced to use a special service like Western Union, because there are simply no banks in that country, and Western Union or other companies are your only option to transfer money at a high fee to these countries. And of course, multinational banks have offices and branches in other countries as well. Small personal example, a couple of years ago, almost 15 years ago, I opened an account with Citibank. At that time, Targo Bank, which has a branch right around the corner, Targo Bank, now owned by Crédit Mutuel, was owned by Citicorp and Citibank. And they tried to open a business here in Germany, and I opened a Citibank account. Why? Because I went to Japan for my exchange semester, and this was quite convenient for me because I could simply go to the Citibank branch in Kyoto and withdraw money from my German bank account without paying 20 euros per withdrawal, which I would have had to pay if I had kept my Savings and Loan Association account. So if you go to Deutsche Bank, and usually it's just Deutsche Bank, you might expect a branch in a foreign country, and then of course you can withdraw money there. Yeah. Okay, so I think that's enough for today. Do you have any questions? No questions? Then thanks for the attention and see you next week.